to our, sorry, I was just checking that the timer was working there. It seemed to be a little bit delayed. Welcome back, in case that didn't come out at the very start of the video. Welcome back. We start again. We started yesterday talking about our introduction to the introduction, which was looking at the timetable. And we talked yesterday about yesterday being lecture number 1, of course, if you're watching this sometime down the road. So there is a lecture 1, this is lecture number 2. So in lecture number 1, we talked about some of the basic concepts and things that we're going to be looking at. And if you remember, we said that the purpose of accounting information, or the purpose of accounting, is to present information. And what's included and what must be shown must be useful for users of accounts. In this, which is now lecture number 2, we're now going to go and look at 2 of the basic concepts that we're going to be looking at. So those basic concepts are going to be the accruals concept, and then we're going to look at duality. The accruals concept is going to tell us when we recognize transactions. So we're going to go through this, so you don't have to understand what it is at the moment. But I want you to know that what the accruals concept does is it tells us, therefore, is when does a transaction take place. And you'll see when we do it how that works. The second thing which we're going to look at is this concept of duality. Now, duality is how we actually record transactions. Now, the word duality means 2, and you will see, therefore, that for each transaction, there must be an equal and opposite effect. Okay, so for now, all I want you to know is that we're going to cover accruals, which is a concept, and we're going to cover duality, which is a way of recording information. Okay, I think that's probably enough for slide number 1, actually. Okay, hopefully we've got the timer right for this one. I'll try and move a bit closer as well. Some people have written on some of my videos that they can't hear the sound. I did try to use a microphone, but it seemed to muck up the computer as a whole. Right, now we're on slide number 2. Slide number 2 is talking about the accruals concept. And with the accruals concept, what the accruals concept says is, and as it says on the bottom of your slide, that we show income and expenses at the time when that income or expense arises, not when we pay the cash. Right, the easiest way to explain how that works is through an example. And this is one of the best examples I've had. This is actually an example that was used to me when I started to train as an accountant with PricewaterhouseCoopers back in the 1980s. So have a look at the slide and have a read of it. It tells you, you can turn me off and then turn me back on when you've read the slide. Hopefully you've now read it and you're back. Right, so it tells you that Sally moves from wherever she moves from to the city. And when she gets to the city, she discovers that she has to use the metro. It's the metro in Moscow, the underground in London, the subway in New York. I hope you understand what this thing is. She has to use a train thing to get to work every day. So she goes to buy herself a season ticket, and the season ticket costs $1,200. Once she pays $1,200, she can use that ticket any time of the year, any day, any night, blah, 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 to travel, unlimited travel on the underground metro subway thing that she's traveling on. So the question is that when she's describing the cost of that, and it's a 1-year ticket, when she's describing the cost of that 1-year ticket, does she say, okay, it cost me $100 a month to use the ticket because it's $1,200 for 1 year? Or does she say it cost me $1,200 to travel on the 1st of January, and then for the rest of the year it's completely free? Right, that's your discussion. Now, the way that she describes that is the difference between cash accounting and accrual accounting. If you cash account, and government, many governments do this. If you're sitting in Africa or somewhere, it's probably that your government does this. If you cash account, then you will account for a transaction when the cash moves. So therefore, Sally will say, it cost me $1,200 to travel on the train on the 1st of January, and then it's completely free for the rest of the year, because that's the day that the cash moved. If you accrual account, you will say no, or Sally will say no, it cost me $100 a month to travel on the train. Right, and that is accrual accounting because the cost of the ticket spread over the life is $100 per month. But there's 12 months in a year, $1,200. So accrual accounting will show as an expense $100 per month. And cash accounting will show $1,200 in January and nothing in the other 11 months of the year. Right, now that is the difference between those two things. Now, if you're sitting there thinking, well, it's 1,200 on the 1st of January because that's when I paid the bloody bill, then that's absolutely fine. There is no right and wrong answer to this insofar as the logic. The logic is if your brain works 1,200 on the 1st of January, that's it, then your brain works on a cash basis. If your brain is telling you 100 per month, then your brain is working on an accrual basis. So as far as the logic goes, there's no right and wrong answer. And as I've already said, many governments account on a cash basis. But for the purposes of financial accounting, you must account on an accrual basis. So therefore, for everything that you do in this course, and if you're studying ICAS, if you're studying ICAEW, studying ACCA, everything that you do in financial accounting, as far as the actual preparation of the debits and credits is concerned, will be on the accruals basis. Okay, so accrual-based accounting is what you're going to be using all the way through this course, and accrual-based accounting, therefore, is based on this idea that expenses and revenue occur as and when that revenue or expense arises. Now, if you're not a native English speaker, get your head around that verb, to arise, because that's what it means. Cash accounting, I'm afraid, has no purpose in this course, unless you're doing cash flow statements or something like that. Okay, I hope that's clear. Read the example again. Sally will tell her mother, if she's accounting on an accrual basis, that the cost is 100 per month. And that's what the accrual basis means. You'll also see it called the matching basis because we are matching the expense with when it arises. And the same applies to income as well. Okay, we appear to be recording now. I'm doing this so you can't actually see me, yeah? Right, so what are we actually doing? Well, what's happening to you now is that you are preparing your accounts for the year ended the 31st of December. So let's just have a look and see, therefore, what are we going to do? Right, what are we going to do? And that actually is the question. So we're going to go through the next 5 or 6, and on the screen at the moment you can only see 3. We're going to go through these individual items, and we're going to decide whether or not we're going to include them in our accounts. Now remember, this follows on from the accruals principle, and you show expenses when they arise, not when they are paid. So you're preparing your accounts for the year ended the 31st of December. As at the 31st of December, you have received your mobile phone bill, but you haven't paid it. So the question, therefore, is, will you include it as an expense for the year ended 31st of December, or will you not? Well, the accruals basis tells us that we must include all expenses which have arisen. So therefore, as at the 31st of December, we do have a liability for this. So the answer is yes, we will include it. So therefore, yes, we will include it. So if I put yes, that means that yes, it will be included. Do that. Is it going to go red for me? It is. And now what I'm going to do, I'm going to put up here, is that we will include it as a phone expense, and we will include it as a payable. Right, what we're doing over here on the right hand side of the screen is that we are showing where these things are going to go. Now, I haven't really explained to you the concept of duality yet, but the concept of duality means that everything has to go into 2 places. So we'll come back to this, and I'll probably just say that sentence all over again. But the 2 places that this is going to go to is it's going to go to phone as an expense. Now, later in the course, you're going to hear me call that a debit. and if I can spell it correctly, which apparently I can't, it's not going to auto-correct for me, as a debit, and you're going to hear me call that as a credit. Right, so far, you haven't been taught this, so you won't understand it. All I want you to do is just accept it. The ones on the left are debits, the ones on the right are credits. You're not expected to know it, and you're not expected to understand it, but it's a language, and the quicker that you get used to using that language, you will find the quicker that it will come. Right, what are we doing? We're preparing our accounts at the 31st of December. We said we use the accruals basis, so we must include expenses which we have incurred even though we haven't yet paid for them. Your mobile phone bill in December falls into the accounting period. It's before the end of the year, so even though we haven't paid the bill, we must include the expense. So we have a phone expense, I've called it here. There must be a credit, so the credit goes to payables. Let's make that payables. Right, you have used the electricity bill, and the electricity bill is exactly the same principle. So with electricity, you have an expense. Notice how the expenses are debits, and you haven't paid it yet, so you will have a payable. The electricity has been incurred in November and December, even though at the 31st of December, no work has actually been done. So therefore, we show it as an expense and we show it as a payable. Right, the third and final one in your list. You've signed a contract agreeing to pay $10,000 for consultancy work. At the year end, no work has been done. Right, notice that even though the contract states that no work has been done, the expense has not been incurred. That expense will be incurred when the work is done. Okay? Right. I know you've signed a contract and it will definitely get paid, in so much as you know you're definitely going to get paid, because how often do we hear that? But at the year end, no work has been done. So at the year end, we do not recognize this. You have no liability and you've paid no money. So therefore, there is nothing to put in your accounts, even though we're definitely going to get paid. Okay, that's a tricky one. When the work is done, it goes into our accounts next year. 3, 2, 1, it counts down. Oh, excuse me. Right, what we're doing, therefore, is now we are continuing with this idea. You are preparing the accounts at the 31st of December. When you are preparing the accounts, you are being asked whether or not certain items, so far they've all been of expenditure, whether they should be included as expenses in the accounts. So period to the 31st of December, should they be included as expenses or should they not? That is the question, whether it is nobler in the mind and all of that. As you can see, we've got the two columns. We've got the two columns because we talked about this idea of duality. So therefore, with this concept of duality, you're going to put it in two places. And I said to you so far, there are these things called debits and credits. Don't worry about them. You're going to spend so much time doing them when you come on to them. So we're just going to look now at 4 more examples, and I will do these examples for you again. So it tells you you have received a bill for your car insurance. You are asked to pay it by the 31st of December, but the cover begins on the 1st of January. Right, what does our principle tell us, the accruals principle? The accruals principle tells us we include expenses when they actually arise. Remember that? When they arise, not when they're paid. So as far as the expense goes, you do not include the expense. So I'll write that on here now. Let me see if it's going to let me write that. Oh, and it is, yep. So you do not include the expense because there is no expense in the current period. There you go. It will arise in the next period. But can you see that you are being asked to pay it? So therefore, what's going to happen is that you will have to show the movement of cash because the cash is moving. So what you're going to do is you're going to put an entry in your accounts in a little account that's called prepayments. When cash goes down, we credit it. So therefore, I can just correct all of this now. Right, for now, this is called a prepayment account, so it's not an expense account. It's a special account where you show that expenses have been paid in advance. So it's advance payments, pre-debit. So we pay this thing in advance, okay? So there's no expense in your profit and loss account, in your income statement, but we have this thing called a prepayment. We must make an accounting entry if the cash actually moves, okay? Get your head around it. Please, can you just remember this as well? When cash goes down, you credit it, okay? So crediting cash will make cash go down. You're going to come back to that soon. Right, that's your bill for car insurance. No expense, but we must make an entry somewhere in the books and records because there's a movement of cash in the year to the 31st of December. What we saw with the last entry on the last slide was that there was nothing happening at all. Right, you have signed a contract with the builder promising payment of $20,000 for work that will begin next year. This time it's the same as on the last slide, you have no work and you have no cash. So therefore, if it's going to let me do this, I will just copy this and we will put you down here. There's no expense. There's also no need to make any entry here because there's no movement of cash here. Did you see in the first example there with the insurance, you had to make some form of an entry because there's a movement of cash. With this one, you don't. There's no nothing. Right, 2 members of staff who have contracts paying them $2,000 per month, you pay their salaries at the end of the month. Right, let's assume you go to work, you work in the accounts department of, Ford Motor Company or somewhere, you get your salary on the last day of the month. Can you see at the 31st of December, that money's already included? You're not making a year-end adjustment because it's already been paid. So therefore, what will have happened is that they will have entered wages and they will have entered cash when those two people got actually paid. I'm going to put it here because so if I put it over here, there's no adjustment. This payment will be made with wages. Right, just stop a second and just think what we're actually doing here. We are making year-end adjustments to our accounts for items which are not included. But this item is already included. So that's why there I've put it, because it's already in there. So you don't need to make a special adjustment for it. Is that quite clear? So it is in the accounts. But we are looking at items which require special adjustments, and this does not require a special adjustment. Okay? So this does not require a special adjustment because you've already been paid it. I hope that's clear. Finally, your staff are awarded a bonus in December, but this is not actually paid until February. Right, now we've got something. The bonus is due and payable when the directors of the company or the managers or whoever decide that it's actually payable. So therefore, we will make an adjustment. So we will make an adjustment. So we will make an adjustment. Right, because it's not in the accounts. It's not in the accounts because it's not been paid yet. So therefore, we will put it into wages. It's an expense, so it's going to go on the left with all our other expenses. And we just wire you up. And that should be, let's just change it to payables, because that's what they can. So these are your payables. These are also called in the good old days your creditors. So therefore, your staff are awarded a bonus in December, not paid until February. So at the 31st of December, therefore, we will make an adjustment. We will debit wages, we'll include it in wages, and we will for payables. The 2,000 per month, I think for each of them, is already included in wages. So there's no, but it's an expense. It's already there. Your car insurance is not an expense. So it'll go to a special account called prepayments account and we park it there. And then next year, we bring it back and show it as an expense. For our builder, we have nothing. Right, so let's just have a look at what we've done then. We've looked at this concept of accruals and we've talked to you about this person who we've called Sally, who had this ticket for the Metro, and you saw how what Sally would have included it as an expense in her profit and loss account every month was $100, if you remember the example we've had. Then I've shown you how to look at individual examples. So you've seen the fact that even if you have a contract, that you've signed a contract, if there's no work been done and there's no money been paid, then there's no adjustment to be made at all. You've then taken it another step forward and you've seen therefore how where we have the situation where there's no expense because the expense doesn't arise until next year, but because you've got the movement of cash, that we've had to include something because in our books and records we've had to reflect reality, and the reality is that our cash has gone down. Then bring into the mix this idea of debits and credits. We haven't done debits and credits yet, but I've already started talking about them and using them, and that's a deliberate thing to do because I want you to get this idea that there are debits and credits and that expenses are debits, and you saw how cash went down as well, and you saw how cash went down when we credited it. So just try and keep that in the back of your mind. It hasn't been explained to you, and you're going to get loads and loads of practice of this as you go through the courses. You saw as well that we had the two columns. So for every single entry, we saw this idea of duality. And so with the duality, you saw there that what happened was, as we said, there were two entries. So we saw that with the expenses, you had an expense went up and your cash went down, or you had this idea of liabilities, or what we call payables. And so payables went up as well. So once again, you're just getting a very, very nice, simple little idea there about what's happening. It's learning a language. You're seeing how the language is functioning. As with all things when you're learning a language, you're always trying to function at a higher level than what you've been taught. So just keep with it, bear with it. Very, very few people who haven't done this before are going to understand exactly what they've done so far. But just remember it, and then you'll find as you build on it and build on it, your brain will automatically process it and it will come to work. Right, we're going to do like 2 more of these, which are just going to be more and more examples because there's only one way to do this, and it's just to do 5,000 of the damn thing. So I'm not going to do 5,000, but I'm going to do another 10 or so for you. See you in the next lecture.